morning, Mr.
Wow.
Greider, and
Good
welcome, Mr.
morning.
Anderson.
Good morning.
2024 is here, man. I'm so excited, right? If you get into this, you see a little excitement of 2024 coming. It's been a kind of a rougher 2 years in our industry, right? So we'll talk a little about that and the opportunity. I was, kind of in our staff here, we just looking around, and go, man, the opportunities in 2024 is there for those of us in our industry that stuck it out, right? So we have these cycles in our industry. We all kind of know that. And with COVID hitting and the rates being so low, because, at Infuse it and low cost, kind of had this big influx of business that came in, right? And it's kind of artificial when rates are low, that low at 3%. I mean, we're doing non-QM at 4% or a little bit under that. That's unrealistic, right? But then we had this big increase in rates in 2022 and how the companies dealt with that and how the markets dealt with that. Then we went through 2023, and I'll talk a little bit about that as we go through that. But 2024 should be exciting for everybody on this call and for our whole industry. So opportunity is what our theme is for 2024. So let's go ahead and go with the webinar we have today and the first one of 2024.
Awesome. Thank you. Thank you, David. Good morning, everybody. Good afternoon. Happy New Year. Welcome to 2024. As David said, it's going to be an exciting year for us here in the industry. Once again, we have our disclaimer, so thank you in advance for your participation and support. We have another robust agenda today. Love these agendas. A lot of information to cover, as David said. And as a reminder, everybody on the call will receive a copy of this deck and of the call when it's over. So let's look at our presenters, of course. Welcome back, Mr. Greider, our SVP of Wholesale Lending. My name is Andrea Formato. I'm the Sales Training Manager here at Home Express. And welcome, Mr. Rob Anderson, one of our Regional Sales Managers. Thanks for joining us today. Happy to have you.
Thank you. I'm glad to be here.
Excellent. Okay, well, David, I don't have a poll yet, but you know it's coming. So I'll turn it over to you first, and we'll do a poll in a couple slides.
And I start out the year, we kind of look at what the forecast is and what we mean by opportunities. And I'm going to kind of go back, in time here a little bit, because I started in non-QM in 2015. So Dodd-Frank made some rules in this manual underwriting and kind of set some guidelines for ATR and things of those you can do. And it was really kind of challenging to get that word out of what non-QM is and what the difference was from some of the 05, 06, 07 errors, and they are some big differences. But we went around, and a lot of us did, some of these other companies too that have been in non-QM for a while, put a lot of flyers out there trying to educate people. These are actually good loans. They just don't fit traditional financing, right? But it's really progressed over time. And so then I've talked a little bit about why 2024 has got the opportunities and what we're going through there. So I'm going to talk a little bit about the housing forecast. And, 2023 wasn't the best year in mortgage volume, right? Came out to be about a little over 1.6 trillion. But the good news is it's forecasted to be about 2 trillion going into 2024. And that's about a 20% increase. And this, don't worry about the small print on this. You're going to get a copy of the deck on this as it comes out to kind of see kind of where it's at. And we saw rates last year, I talked a little bit about kind of historically from COVID and everything happened. Man, it climbed up to, I saw some rates on conforming at 8, right, in Q4. But we always see right in the last probably 30 days a downturn trajectory where everybody's projecting rates to have some type of downward trend. And like what happened with a huge increase that was so, the velocity was so fast that really kind of jolted the markets a little bit, especially in the mortgage industry. But I predict, and what MBA is predicting, it's going to be a slower decrease, right? Which is probably the right thing to do. Anytime you do something dramatic on rates from going low to high, then high to low, you get dysfunction, right? So if rates really went low, it really affected the mortgage industry and probably servicing of that. We have a lot of EPOs, everybody wants to refinance, where you want to kind of go step down into that to get to more sustainable market over time, which we project will happen in it towards 2025 and going into 2026. And the one thing I've looked at, and I've talked to a lot of people in the industry, with a real estate agent or some type of in our industry, they've seen an uptick in the calls and the business in those units, right? So for one instance, one person that kind of works on has a spouse that does sets up the house for open houses, right? Going staging or whatever you have it, and traditionally maybe 3 or 4 calls a month last year, right? That's it. Already had over a dozen calls to start out this year to kind of do that. So we're seeing more inventory come out there and try to capitalize on homes. The one thing there is some still locked in effect that's happening, but there will be more inventory coming aboard, and with rates coming down, hopefully affordability will come in for us. So the opportunity is great out there. So let's go to the next slide and look at what it means for non-QM, because that's kind of where we're at with Home Express. So I kind of got the slide up there from going up about 20%. MBA says it's different timing, they'll tell you, but it's right around the 2 trillion, which is a big gain of 20%. Especially those that did the right things in the market, right? So the market goes up and down. We kind of know that. I've been doing this for 30 plus years, not there, but you consistently do the right things, right? Take care of your clients, give them the right advice. When the timing's right, you just explode. Those referrals come in. So how is it really affecting non-QM, right? So all this side, you'll be able to read it there, but non-QM has really, kind of about the end is poised for long-term sustainable growth, right? The reason that it's got acceptance, and not only acceptance, for the consumer, the ultimate borrower, doing it, but even in our mortgage banker, broker community, and on Wall Street and the securitization market. There's a track record of it right now. And we do know that some of the statistics have changed with the makeup of the consumers, right? So a lot more maybe not qualify for traditional financing are going to fall into non-QM. And we've seen it kind of go through doubling in 2022, representing the market about 4%. That is actually going to increase over time, and you'll see a big increase on that. So on the next slide, I kind of give you a little bit heads up of why. Why is this happening? And why am I focusing on kind of maybe 2 programs?
So before we go to that next slide, David, we have didn't mean to cut you off, but I'm so excited for my poll.
Let's see the poll here, right?
All right, whoops.
Don't see it yet.
I know. Oh, here. Okay. Okay.
I see it. It's
okay.
There.
Poll number 1, everybody. This is your chance to participate. What percentage of employed workers are self-employed? So this was an interesting one, David, when we were looking at it, right?
Yeah, it was. I think most people will get in the 30% range. That'd be my guess. I'm just going to throw it out there. 30%.
You're actually spot on. Let's just see. It looks like people are still answering here, so we'll just give it another minute. Okay, it looks like we're done here. I'm going to go ahead and end the poll, and I'm going to share the results. So you were right. They said 30%.
They did. And I actually think it's more than that, but I have to go by the Bureau of Labor Statistics and all those types of things. Because it's what they report. What they report to the Census Bureau is kind of what you have to go by. But when I'm looking at non-QM, and why specifically this, non-QM has a wide array of products. So we carry a lot of different programs. But fundamentally, you look at non-QM, it goes into really 70% of it are really 2 programs and how it's designed, right? One is the self-employed borrower, right? And what I mean by that is that they have great accountants and they're self-employed for a reason, right? And they want to keep, their money in their business, and they believe in the constant retained earnings. They want to minimize their tax liability. And traditionally, when you look at their tax returns, it could be liquidity tests, could be all these other things. They don't work out where that works out in non-QM based on the cash flow of that business, whether it's business bank statement, personal bank statement, lots of different ways to go. We'll look at that. But when you look at it, this is just 21, 22, 23, what that segment is going to, right? So you can see where this is trajectory. And I do think it's a lot has to do with, the cost of living today, with the migration from urban areas and those into more suburban areas or even rural areas where you're saying, I don't have to live in a big city. The market has changed where you can work from home. They may take a 1099 job, some type of other business on there. So when you look at this is what we have from the U.S. Census Bureau, which I think is a little bit low, and you will kind of look at that more with that. So there is a lot amount of self-employed workers out there. And so when you look at the spectrum non-QM, this is a big section. And you'll see that when you see some applicants coming in. And man, these are great loans. They have great cash flow. Just great demographics on this, right? So let's look at another market here where I talk about kind of this segment where 70%. So out of the 70%, we got the self-employed. And we'll go to the next slide and look at some other segments. Investor loans, man, and this kind of surprised, didn't really surprise. We kind of see it. We got empirical data because we see the loans coming in, and we kind of look at why we're getting such a big percentage of these small to medium investors coming in purchasing residential homes, right? So on this article, and you'll get this out there, it's done by CoreLogic, and some of the sections in the middle say that in 2019, from into 2023. It increased about 43,000 a month from the small to medium investor purchasing investment properties, right? That is significant. And we actually seen that in 23, and I think it's going to continue in 2024. Now you can look at the investors, right? The mega investors institutional, that's actually slowed down, where more of the small to medium investors are purchasing investment properties. Maybe they're looking at the stock market, where they're going to put their money, and kind of knowing the fact that we have more demand for housing than we do have housing, right? And that's in there. The locked-in effect to just the amount of individuals that are looking for home and waiting for that affordability, and sort of capitalizing that right now for the cash flow of that property, maybe appreciation. But you'll see where it's kind of probably more geographical. And we're going to take a look at that. Where are these borrowers going to purchase investment properties? So we'll go to the next slide and kind of look at that. So in the darker the blue, this is the section where you have the highest percentage of purchasing for investments, right? California, again, you got a very populous state, that's it. But you'll see the Southwest, all the way through Texas. You see Florida, you see Georgia in the Southeast, a little bit less in the upper Midwest and the Northeast. But this has been a tremendous, and I can attest to that because we see the loans coming in. And I actually think the unit-wise is probably 65, 70% of the loans we received in the last 6 months are these small to medium investors purchasing this home or doing a cash out to buy their next, or a combination of loans, right? We're getting a cash out loan for them to purchase their next investment property. So these are states. I wonder, Andre, do we have another poll question here coming up?
We have it coming up right after this next slide, David.
Okay. So when I look at non-traditional income, right, and this is going on these two spectrums that make up 70% of the volume in non-QM, and we're going to take a deeper dive onto the next webinar, which you'll see that is the self-employed. How do you get those approved? Well, traditionally, the easiest way to go is a 12-month business bank statement. That's typically where the larger deposits are, and then we take an appropriate expense factor based on the business type, the location, how many employees on that. And so really it's not that. Again, you can still get a CPA letter for expense factor. We also have P&L only programs that make sense. They also have acquired some assets over the years. We have asset programs where they can qualify, and the 1-year full doc. You'll see where sometimes where during COVID, they kind of regrouped, maybe didn't have that great financial position just based on their business, but now they're back on track where the 1-year full doc on tax insurance could work. So that's it. We're going to take a deeper dive on that next month. But let's go to the next poll question we have when we look at the other segment of where most of the non-QM loans are.
Okay, let me launch that. Do you see it?
Yeah, I do see it.
Okay, excellent. This is our second and final poll today, everybody. So true or false? I have to have a business purpose license in a particular state to do business with Home Express. Would you think everyone's going to get it, David?
I think it's going to be 50-50. That's my guess.
This is a good one. This is going to lead us right into the next couple of slides, because maybe not everybody understands, right? doing business with Home Express and Business
Yeah,
Purpose.
and other lenders, non-QM lenders as
Mhm.
well. They could be paying it, doing some other things as well in this segment. As you
All
see,
right.
as non-QM grows, and get more uniformity kind of in programs across the board. I mean, non-QM is really accepted at most lenders here. So we got false of 88%. Man, we got some bright people on this
I
call.
know.
Right.
Excellent.
It
Very,
is
very
actually
exciting.
false. That is great. So we're going to look at that. So if you look at the states that are on there, I wonder if you need to be on there. But let's look at the small to medium investor type programs, right? And we have really kind of looked at these guidelines to make it streamlined for you to get it done. Now, most are done, I'd say, primarily on the debt service coverage ratio, right? And you kind of want the one where the cash flow is equal to or greater than the total mortgage payment, or PITIA, whatever you want to call that. But we're not limiting the number of properties one of these borrowers owns. We can do up to 10 loans. These are non-TRID. That means they go fast. That's the difference on business purpose and why you can do loans in other states without an NMLS license, right? We have programs with a DSCR down to 0.75. This is where you go in the spectrum of like foreign nationals, right? Or with a citizenship type that are out there, right? And so if we do see quite a few coming in full doc or all doc, where our pricing and programs are better than maybe a Freddie or Fannie program for that, or maybe meets that needs a little bit better, right? Where you don't have to go through a whole bunch more, but you get a better price with that. So let's take a look at the next slide on these states that do not require an MLS license. So here they are. Everything in black here is a business purpose loan license not required. So you could be an NMLS loan officer in California and do a business purpose loan in the state of Hawaii, Texas, Florida, Georgia, Alabama. It kind of opens it up, and it's really kind of networking out there of where these homes are. And we did see over the last 6 months the average loan amount go down, and that's primarily because some of these states and these small investors are looking for that cash flow, and they probably are typically the homes, given the rates of where they were at close to 8% or 8.5% on these loans, were into those type of segments, right? So they're looking for that. So you look at those loan size, probably a little bit lower, but there's some other ones that are great too. But this kind of opens it up on your marketing going into 2024, I would think, right? You have a lot of people that have moved to other places, right? Or you have real estate agents that you can connect to a state. Say, I got programs for you that you have with your real estate agents that have these type of clients, and I think most of them want these type of clients because they'll buy them, they'll fix them up, they'll rent them out, and they'll look for more opportunities down the road. Given the fact that we have a shortage of single family residents in America and lots of pent up demand. So let's go to kind of the next slide, and I'm going to hand it over to Rob Anderson, who's going to talk a little about where to find these borrowers in these two segments and some of the tools you can use in your thing. And Rob's just out in the field. He talks to brokers every day. He talks to the AEs that are dealing with that. So I think it's a good segment to have Rob talk about some of the things that he sees where the successes are. So Rob, I'll turn it over to you.
Great. Appreciate it, Dave. Yeah, so a lot of you are saying, yeah, these are great programs, but how do I use these to grow my pipeline? You know, how am I going to use these types of programs to get more business in 2024? Well, here is what we're seeing overall as brokers that want to concentrate on non-QM to get more business. Here's where they're going after. Now, there's the obvious ones, real estate agents. That sounds like a Captain Obvious, but what we're seeing is some loan officers are designating themselves as a non-QM expert. So they'll approach an agent another way than, hey, I have fast service and great rates. They approach them as, I'm the expert for your borrowers that may not be able to get qualified. I have other options. So they're going to their real estate agents as true consultants on how to get some of their buyers qualified, self-employed buyers mainly. Also, traditional lender fallouts. We see that all the time. You have the retail companies that don't really want to do non-QM. Maybe they're still a little bit afraid of it, or they just don't want to take a risk. Look for those fallouts from your real estate agents. There's always the other obvious ones, social media, Facebook, TikTok, Instagram, LinkedIn. LinkedIn is full of small business owners. A great way to advertise is on LinkedIn. And then something you may not think about is builders. Builders always have their go-to lender, but if they have a borrower that's halfway through the contract and all of a sudden maybe their most recent tax returns aren't as good as they were, now they have a fallout. The last thing that builder wants to do is go and get another buyer for that house. They want to close that house and get it off their line. So builders are a great way to pick up some of this non-QM business. CPAs. I mean, CPAs, probably 50% of their clients are business owners. CPAs are a great resource. So make friends with CPAs, find out, they have the inside scoop. When people are getting their taxes done, they're telling them everything. Hey, yeah, I'm thinking about buying a house this year. I'm thinking about maybe buying an investment property. CPAs are a great resource. Small business networking groups. I'm seeing these grow again. There's groups like Meetup, Mastermind, LaTip, even the local commerces. They have small business meetups every month. It's a great way to take an hour out of each week, or maybe only once a month, and you're networking with small businesses. But the one thing that I think a lot of people miss is every time you do a transaction, you're dealing with 3 or 4 small businesses on that transaction. Think about your appraiser, your inspectors. Maybe you need a roof inspector. Sometimes you need to go out and hire a handyman to fix some of the issues on the house. Every transaction is going to have at least 2 to 3, 4 small business owners in that transaction. And then think about your daily interactions. You have a housekeeper, maybe you have a pool person to handle your pool. Those are all great resources for these self-employed bank statement programs. And the biggest obstacle when talking to self-employed borrowers is, I write too much off, I won't qualify. Well, now you have something else to go out and see if they can qualify. We're seeing it all the time. With the market the way it is right now, inventory low, there's still a lot of opportunity for these borrowers to finally get into the market and purchase a house. We see a lot of the jumbo loans come our way because jumbo guidelines are still so stringent. You cannot use bank statements, and the DTIs are tight. So a lot of times, even if their tax returns are good, they still won't qualify for a jumbo. Well, now we have this self-employed 12-month, 24-month bank statement to fill that gap. So lots of ways to find these self-employed borrowers. Our AEs are always willing to jump on webinars with you, or if they're close to you, they'll come and meet with realtors with you. They're more than happy to help support you in finding these self-employed borrowers. So now we're talking about investors. Where are these smaller investors that own a few properties? Maybe they want to grow their properties. Again, Captain Obvious, real estate agents. But with real estate agents, again, you want to set yourself up as the investor borrower expert. You're now being a consultant. You're consulting your realtor on how to get their investor or potential investor buyers qualified. Commercial loan officers are great because most commercial loan officers, you have to have at least 5 units, but they do have borrowers that are looking for 1 to 4 unit investment property also. Talk to your commercial loan officers, get referrals from them. Property management companies, they're always looking to grow their business. Well, what better way than to get their current clients more property? Again, social media, that's another obvious one. Set yourself up as the expert. That's the biggest thing you need to do, is set yourself apart from the other loan officers by becoming an expert in self-employed or investor borrowers. I saw one broker did something amazing. He got a group of doctors. They started buying short-term rentals. That has grown because now you see you can lend in other states you're not licensed in. So he's grown his referral base to 5 states, and he's just doing amazing. And it's all through doctors that want to diversify. They want to buy some short-term rentals, and they want to diversify their portfolio. Hard money lenders, a great resource. these hard money lenders want to get out of these hard money loans once they're maturing. So they're a great way. And believe it or not, we did a ton of rate term refis last year just from taking people out of hard money to our loans. You know, you're saving them 2-3 points in rate in a month. Network with financial planners. Financial planners are a great resource. So they know when their people want to diversify. I mean, a lot of people got a little bit hesitant to get into the stock market. They wanted to diversify. So real estate's a great option. Create a team of realtors. Investment seminars are a great way to find potential investment borrowers. We will do first-time investors on our program. So if you can create a network with your realtors and do a seminar on a Saturday morning, again, our AEs are more than willing to help partner with you in this. Lunch and learns are great. And we're just presenting a different option for those realtors and for first-time investors. And then last, now that you see you can go to other states to get more business, start calling realtors in resort areas, you know, the ski resorts in Colorado, coastal communities in Florida, Hawaii. There are so many options out there, and short-term rentals are big right now. We do allow short-term rentals, and a lot of people are interested in getting into that market because those are more profitable than long-term rentals sometimes. And there's a way to make a really good profit on short-term rentals. So it's a great way to help your realtors get more business and get you more business. And it's a great way to help people diversify their portfolios. So with that, I'm going to send it back to Dave so he can share some real-time loans that we've done recently.
Hey, great job, Rob. And there's a couple of comments in there. Yes, everybody's going to get a copy of this deck that registered for the webinar. And again, to me, I always look at, you need to really connect to one of our highly trained account executives. We have tools. We have some white label flyers we can develop for you to help set up some of these things to kind of get the word out. I think Rob talked a lot about casting a wide net and becoming an expert and portraying that. And you have a company and AEs here that can back that up and help you navigate that so you can close more loans and get the next referral because you can close these loans, right? So just give you an example. And I get these requests to give me some examples of recently closed, right? So, okay. So here's one's a purchase state of California, self-employed, had to use bank statements, funds to close 100% gift, right? Yeah, okay, we could do that, right? So ATR met was, you look at the cash flow of the business, bank statements. We have programs 100% gift with 20% down and 6 months reserves and had limited payment shock. Made sense. Close that really quick. Scenario number 2, there's a purchase state of Nevada. Agency fallout due to DTI. And all it is, the LO called one of our account executives. We just went through everything they had. Man, this guy had a huge amount of assets, right? Very easiest to do the asset express, which is asset in full, right? A great loan. Guy who got turned down because his taxes didn't work out on traditional financing. Scenario number 3, purchase state of Florida. This was a non-warrantable condo because the condo complex had partial leasehold, right? And you'll see that kind of in certain areas in Florida where the recreation facilities on leasehold. We're fine with that, right? So anyway, so it's a turn down going from traditional financing. We're able to get that done at a great rate and close that purchase that's out there. So as we go into this, I'll take some questions and from anything you have. That's anything I do, non-QM, industry, self-employed, you just fire away and I'll try my best to answer any questions you have. So Andrea, I'll leave it up to you to kind of look at the questions that we have coming in.
Sure, sounds good, David. So we have a couple. So one of them is, what is the minimum amount of time a person has to be self-employed?
That's a great question, right? So generally, if you look at self-employed borrowers, it's 2 years. But we do have programs for at least 1 year self-employed. Now, what does that look like? You have to be kind of manager or supervisory position in that like industry and business. Then you transfer over. And I always give the example like the doctor at Kaiser does his residency, right, at a hospital. Then, 15 months ago, opens his own practice. And you kind of see the cash flow, does a lot of expenses, get it going, then the cash flow starts going up. And by the way, these people have great credit in that, and they get shut out of the market on buying a house. We have programs for that. So technically it's 2 years, but we do actually have programs for 1 year self-employed, as long as they're W-2'd in a position that's very similar or like that in a supervisor managerial position or professional in nature.
Great, thanks, David. There's a couple more coming in here. On non-warrantable condos, what down payment is needed in Florida?
In Florida, it depends. I mean, typically on you go non-warrantable condos a little bit less, but we can actually go up to 80% on some of these property. It really depends why it's non-warrantable and looking at the risk of the loan. The typical one we get a non-warrantable in Florida would be the leasehold for recreational, or the occupancy is less than 50% owner occupied, right? Those go through really easy. When you get into litigation, we'll look at that, but if it's any type of litigation for defects and that, and it's this big lawsuit house, and those are very challenging. Slip and falls might be okay. We have some systems. So what I recommend for that is it's 20% down minimum, could be 25 depending on where you're at. But run that scenario by us, right? If you don't have an account executive with us today, shoot me an email and you can have my contact, and we'll set you up with some of that to provide the material for you and kind of go through the programs in more depth. But typically, you need at least 20% down, depending on the risk of the non-warrantable condo. Might even be a little bit less than that at 75.
Great, thanks, David. A couple more that are coming in. What do you mean by dual comp allowed? The broker can earn up to 5 points.
That is a great question.
Mm-hmm.
Okay. Now, when you do business purpose, right, you're not underneath the normal regulation of TRID, right, and Dodd-Frank. These are business purpose loans, which then allows compensation. What I mean by dual compensation is that we can actually pay lender paid comp, and you can get borrower paid comp on those transactions. Now, I caution you, I mean, you're going up to 5 points on certain transactions, may not get the deal, right? So just be careful. But we do allow compensation up to 5 points, including dual comp, both lender paid and borrower paid on that transaction.
Great, thanks, David. Okay, there's a couple questions on this one request. So for investor properties, what programs do you allow to close in an LLC? How many owners must be listed on the LLC? Do we have HELOC for LLC investment?
Man, that's a great question.
That's a good
one. Very complicated, right?
Mm-hmm.
We do allow vesting in a business entity, which is typically an LLC, on our business purpose transaction. We do require a personal guarantee. So how many members? It depends how they're formed. We try to get at least, you got to at least have the people at 25% of ownership is really what they're signing on the personal guarantee. I don't know if there's a exact limit, but we actually have a department that goes through these pretty quick. So if you have somebody that's in an LLC that you're trying to do these transactions, just provide that to us up front, what we can do. We can decipher that for you. So it's very hard to say when we don't really limit, how many owners can be on the LLC, but the ones that have the most ownership really have to do the personal guarantee, right? That's what we're after, and then we'll invest in that LLC. And then there's some that get complicated, right? And I'm telling you, it's like they'll have an LLC, own an LLC that then wants to own another property in a different LLC, and you kind of filter it out. Those can be a little more challenging. I'm just telling you they are. So we just got to decide for that, make sure we know what we're lending. So we lend to individuals, right? So that's kind of the concept here. We lend to individuals, but we allow them to invest in the LLC, and the docs come out as an LLC. But we're basing the loan on the individuals that are doing the personal guarantee and the cash flow of the property. So that credit there and the cash flow of the property. So you got to look at it that way. Who are we lending to? That's what we're trying to get to when we look at the LLC, so we know what it is. It's not just someone put on there at the last moment because they have good credit. That's probably not it. Our intent is to call what is deal with it. We have, and it is that borrower that we're looking at that is actually has the most ownership in that. Now, signing the loan docs could be a little different because you could have somebody else be on that business entity, be the actual signer. And we'll go through all that with you, but just provide that LLC document, how you want that vested. We'll be able to tell you within 24 hours, 48 hours, depending on the workflow of that department, to give you back how that would work.
Great, thanks, David. This is the same person that asked about the non-warrantable condos. So she's saying, what about for the borrower has no reserves, borrower had Chapter 7 BK 3 years ago?
You know, our seasoning on bankruptcy is 3 years now, so you got no reserves, right? And then I go into how is that a good loan? So you look at non-QM, especially with homeowners, we're a common sense lender, right? So we try to look at all the variables of this loan and base the loan on the merits of it. So we got a non-warrantable purchase. Now, is this going to be a consumer loan or investment loan, right? There's two different LTVs given whether you need reserves or not on a consumer loan or on a business purpose loan. So I probably have to know that. So in generally, it's 75 or less on a consumer loan may not need reserves, and it's 65 on a business purpose loans. We're not requiring that. But also going to you as I look at a common sense level, I don't want to put anybody in a loan that they may not be able to pay back. I mean, I think that's bad. We got to have a conscience in our industry. So if I look at a loan and shoot, what if their car breaks down next week and then they have to fix the car, then they can't make their payment? I don't know how good that loan, but do they have access? Do they have an exit strategy if something like that happens? So when you go and do your consultation with the borrower, reserves going to be part of it. Even if it's not required, you should have the conversation, make sure it's a good deal. Because you look at it, you go down in LTV, so that's more down payment, then they don't have any reserves. So there's probably something that makes sense with that. And again, we're a lender that we wants to look at every scenario, and we're going to look at its own merits. And that's where we're a little different. So it's not just necessarily a guideline question. It's more, is this a good loan? And we can get that because we're a true lender. We underwrite to our own guidelines, fund with our own money, what gives us lots of flexibility for deals that you may not think can get done, but that makes sense to you. And we want those loans and those scenarios in here to see if we can put those together for you.
Thanks, David. She had a follow-up kind of clarification. Non-warrantable because of no reserves, and borrower had Chapter 7 BK 3 years ago. What's the max LTV?
The complex, the HOA has no reserves, right? That's how I'm reading it. If that's the case, those are very difficult, right? Those are very difficult. You just think about a complex with no reserves, especially in Florida, and a hurricane happens, right? And then their deductible not met, and that could affect the marketability and value of that particular condo complex. So if it's the HOA having no reserve, that's going to be very challenging. So I probably recommend that. That's a tough one to get done. Very hard to get done anywhere.
Okay, thank you. So here's another question that came in. With multiple owners, how do you determine the FICO that's used?
Great, the one that we're using. So we're not one that says, hey, you got two owners and they own, let's say, it's three owners and they all own a third of the LLC, right? You got to have at least two on there, and we're going to take probably the higher of the two, right? Because how do you know, right, which one's the weight? So we're trying to be flexible with that. Right. But if someone on there, we have to look at the debt load and if there's collections on that. So you got to be careful with that. So in those scenarios, our AEs know how to structure these loans for you. Right. So bring that up there and they'll help you structure that deal to get that deal done for you. So it's hard to answer on that. But generally, even on our bank statement loans, let's say you have a married couple on our bank statements, right? And one's got a 720 score, the other one's 680, and they're 50-50 owners. We go with the higher score, right? We do, right? Because if the income level is the exact same, we're going to give, on the ownership levels exactly the same, we're going to go with the higher one.
Great, thank you. So this is regarding asset utilization. So can asset utilization be combined with traditional income? And then how is the asset utilization income calculated?
No, these are great questions.
I know, okay, I know they are. They're coming in.
There's two really fundamental asset programs in non-QM, which we have. One is like an asset in full, which we call Asset Express. That means it's not a DTI file. As long as you have enough assets to cover your loan balance plus 25, so that's 125% after a down payment and reserves. Reserves are actually included after a down payment. It's not a DTI file. You have enough assets to pay us off effectively and handle debt for a certain amount of time. That's how it's looked, and that passes, ability to repay. And then you have assets you can then turn into income. So I can have W-2 or bank statements, self-employed, and have a asset. So we have a kind of some calculations with that. So cash is at 100%, stocks, bonds at 90%. 401ks or retirement plans usually at 70, not your retirement age, that would turn into more of a stock program. So then we take that calculation, divide it by 60 months, and you can add that as other income on the 1003 to get the DTI in line. But great those are done all the time. I just saw one of our first loans came in today, maybe 7 o'clock this morning. Is a alt doc business bank statements with asset assist to get that DTI in line. Very common with us. You can combine the two.
Great, thanks, David. Here's another one. If the property is, I think this is saying 5 units, but the seller is only selling 4, can we fund? The property is on a single parcel.
So I'd have to look at the zoning of it and exactly the legal description of as the title policy be. We're in the residential sector, so it's max of 4 units that we can lend on. So if it is, legally a 5-unit property, that's on the commercial side. So we're stuck with the 1 to 4. So I'd have to look at the legalities of that. And what do you mean by 5 units on a property? Is it a 5-unit property? Is it a 4-unit with an ADU? Those are actually real good questions, right? But you'd have to really look at the legal and how legally it is, right? And when I look at properties, that's exactly what I look at. Marketability and legality of it, and we're in the residential sector. So residential is max 4 units. And so we really have to be on what is that legally.
Great, thank you. There's a handful more, David. So great job. Okay. Can we do condotels?
Yes, great question. We do condotels, right? Now, and again, you go in the guidelines of that. So give us that property, look it up, what it is, right? It's got to have a full functioning kitchen and some of these things that you need to do, which we'll go over that with you individually. But yes, condotels are available here.
Excellent, thank you. Next one. Are private VOMs acceptable for payment history if the mortgage holder is not related to the borrower?
Generally, no. I generally no. It's like, and I go through this concept, and I know property. I have good friends are property managers and private mortgage lenders, right? And I'm going to tell you, I've never seen a bad VOM from them when they want that tenant or that loan paid off. Amazing, right? Shoot, were they going to give you a bad VOM? That's why you need more hard proof on that. But maybe there's something else. Maybe there's something else that is there. How do they pay it? Can you explain that to us? Maybe it's one item out of like 10 mortgages that they have or had that they paid as agreed. Maybe there's an acceptable level on the loan. So let's look at the loan in its entirety on its own merits, not just one factor of it, and maybe we can look at that, right? But generally no. But what's the compensating factors and why was that the case? So let us know why and what else we have to say this is a good credit risk, right? And that's what it is a non-QM. It's say this is a good credit risk, and our documentation support that, right? And so when you get to that, there's lots of ways to look at loans, and that's why I enjoy non-QM. It's not like, hey, here's the conditions for you. No, tell me the story, right? Tell me what's going on with this and why this is a good loan. Give us everything you can have on this, and we'll help you structure that loan to get that deal funded for you, right? So give us the merits of it.
Great, thank you. Next one, do we work with investors who are ITIN borrowers, and do we allow for alternative credit?
Now, a couple of questions there. One alternative credit. Now, we do have an ITIN program, and I look at this, and there's different ways ITINs are done. One in our industry is more of a portfolio type of thing. Generally, we try to make sure it's a securitizable hit in the bond market. So we do have ITIN programs for self-employed borrowers, and I can go into a lot of reasons why, right? For 12-month bank statements, so that's alt doc, right? So on that, but I got to have 2 scores underneath the ITIN, and you really got to look at the credit report. It's not like putting in the 9, right? It goes, I got scores. What is that score associated with? I need 2 scores underneath that. I got to have the ITIN assignment and a state or government ID that matches, right? So those could be challenges in certain states, right? California is not one of them, right? So you can get an ID, they have an ITIN assignment, and you see that. So when someone's self-employed, that's an ITIN. They typically have credit the ITIN because that's how they do business. That's how they're reporting their taxes in the ITIN. Where ITINs have problem is where the income and credit doesn't match the ITIN. It's on some other social security number who we have no idea how to validate that. Not to say they're bad loans. I think ITINs perform very well, right? They typically have money down, they pay you, but there's different ways they are done. But so if they're self-employed, we'd love to take a look at those. It's kind of a topic of the day. I actually think as we go forward as a country, it's going to be more acceptance to it. So this program will evolve as we're going over the next few years.
Thanks,
Now,
David.
alt doc, I think I held that. We do a lot of alt doc. I mean, if I listed our alt doc programs, it's like 15 deep, right? Of all these different alt doc programs. That's why I say I don't really dive into it on this particular call. It's more of we can structure deals. Just got to let us know what they have. They have assets, income, where they, well, we take multiple bank statements, right? Or they may get money off of Venmo here, or PayPal, or Square, and then they put the money here. We're able to figure all that stuff out for you. So don't limit yourself here. So I'm saying don't limit, just figure out what it is and how they get their deposits or how they get their business receipts. We're able to look at those for you.
Great, thanks, David. The next one, this person kind of missed the dual comp, so he was just clarifying. So we can do a combination of lender and borrower paid, like add on the interest yield and add on the origination fee.
That is correct. Up to 5 points on business purpose only.
Thank you. Next question. When vesting in the LLC, do you report to the personal guarantor credit?
Generally, yes. Right. And this is a topic that's come up, but we don't have control of that. Typically, here's how our business model is set up, and we can do our own securitization, we do all that, but typically we aggregate a whole bunch of loans at one time. Let's go 200, 300 million, whatever that number is, and I give them up based on our secondary market strategy, right? So these loans, while we're aggregating, they're serviced, we own them, they're being serviced by our servicer that uses that, right? And so typically they are, right? So that we do on that personal guarantee signs that they're reported. Then it gets transferred. Whoever's doing the securitization, they go through that, whatever that months goes on, gets transferred to another servicer. They may not. So I can't guarantee one way or the other, but we say yes, that's going to be reported. And so that is we do business purpose loans. We don't do business loans. There's a difference and distinction to that. We allow you to do business purpose loans, invest in a business entity, but that's what they are. They're business purpose. They're not a loan to a business. And that kind of separates it if you kind of get that, kind of concept.
Great, thank you. Next one. Are you able to do a DSCR loan with a first-time home buyer?
Yes, I think Rob talked about that. We can. Now, again, there's pitfalls for it. Why? Why are they buying their first-time home buyers buying investment property, right? Now, if I work in a certain location and I'm buying my first home investment property 5 miles away, that's a challenge, right? Because you got to look at, hey, are they going to live in it or not? But let's say I have a doctor that lives in Orange County and he's got this nice place, doesn't want to buy their pricing and all that, but he's got excess capital. He hasn't bought a home yet, wants to buy a rental in Phoenix or Las Vegas. That probably makes sense. So it's really a common sense approach to it, but we do have programs for first-time home buyers on investment, our investment business purpose program.
Great, thank you. On the bank statement program, can the number of months for reserves be reduced to 3 months?
We can make exceptions on that. So the answer to that is yes, we've made exceptions to that. What's the compensating factors? What are we looking at? Right. So the answer is it is an exception. We require when reserves are required is 6 months. And if you have less than this, tell us about it and we can take a look at that. So it's hard to give you yes or no, because we're going to look at the merits of the whole loan and make that determination, right?
Mm-hmm.
And there's many cases we've done that.
A couple more, David. What is the max LTV on bank statement loans? 90%
LTV. Again, that's going to have a higher FICO. You're going to definitely have to have reserves on that. I'm just telling you. As soon as you go higher on LTV, it's a higher risk loan, right? In case something happens, we're going to be a little bit tighter on the guidelines, right? And so the guidelines for that is we can go to 90. You're going to have reserves. And if it's a large loan over 2 million, we don't do that. So the loan size has got to be, within a reasonable amount to do 90. But yes, 90% LTV is available on bank statements.
Great, thank you. For the ITIN, do we require a valid visa?
It's something we don't look for on. It's not a documentation that we look for, right? So if I look at the documentation we look for on I-10, right? I-10, I need the I-10 assignment, right? With that name on there, that hey, that's valid with us. I'm looking for a government ID, right? And it's typically a state driver's license that we get on that, right? For the valid ID, right? And so if you look at it, then you look at the credit, those type of things. So it's not something that, hey, we look at it, I got to have the credit underneath the I-10 and that. So it's not something we specifically ask for.
Thank you. Here's the next one. Any plans on going to 85% LTV on DSCR loans?
I was in credit committee yesterday that came up, right? And I was looking at that, and we look at it and go 85% LTV. I'm going, okay, who does that, right? So we look at what was that really just a marketing by the other companies? Because you got 85%, you got a higher rate, right? So I look at it, you got a higher rate, you got great credit because you got to have great credit scores and great credit to get that, and your DSCR has got to be over 1. And what is that segment like? Then I'm going to say most of the small to medium investors are used to putting 25% down. Those are things we've looked at and maybe we'll look at again. I don't know why that really works. Maybe 1 or 2 files a month or can get there, might get there. And then the loan sizes have to be fairly small for that to work. We all seen where taxes and insurance has just astronomically gone up with inflation, right? How does that work on the DSCR, and what does that look like, right? So it's something we considered, we kind of out there. I just don't know how effective and how many borrowers that really helps, or do they get countered to 80 at the end of the deal, right? So we're trying to be upfront that how many of that would actually work out. Maybe a few of them do. Maybe a few of them are good risk, but right now we're capped at 80.
Okay, thank you. The next one, going back to the 90% bank statement loan require PMI, or is it included in the rate?
PMI, no PMI. Non-QM does not have any mortgage insurance on it. And I look at that way, you got a higher rate, and that's probably where it goes into. So as you step up on rate, especially you start going over 80, some of those increases are a lot larger, right? So there is no extra payment for mortgage insurance, but it's probably included in the rate given the risk, if you kind of look at it that way.
Thank you. The next one, for bank statements, can we use business bank statements that is a C Corp?
Yes. Again, our things we're looking at is you got 25% ownership or more. That's a hard stop, right? It's the definition of being self-employed. Then we're trying to ascertain where their business receipts go on that. So that would be okay, right? So that would be fine, right? There's just a progression of business. You got sole proprietorship, right? Then they get to LLC, right? Or S Corp, and then you get into a C Corp. Nothing wrong with that. We're looking at the ownership of it, and we can get through that. We just got to document that the shares, the predominance of the shares are on our owner, right? 25% or more of the shares are owned by our borrower.
Thanks, David. There's more coming in, so great
Keep
job.
coming.
Okay, great. So a lot of questions on condos. Interesting. If the condo,
which is great because we
Yeah.
do those. We do condo tells, we do high-rise condos. I'm not saying we're going to do them all because we're not. We can't. We got to look at each deal individually, and that's really what it is. Right? And we also seen a transition in HOA insurance, and I understand the constraints. I've actually posed this to our industry. It's like, with the cost of insurance for these condos, specific in Florida, Hawaii, those type of things, we got that. They said, hey, I don't want to pay that as an HOA. Let's just raise our deductible up. And all of a sudden, you don't qualify, right? And so I'm looking at industry, how we're going to do with that. I do think these are great questions on these condos. You're seeing reserves being affected. And I really think these are great questions. We'll take a look at all these on its own merits, but no reserves hurts. Right. That's hard to do, right? If something happens to the condo, that's really going to negatively affect it. Then if they have to spend money or get a loan on that HOA to get that, what is their amount for their HOA premium going to go to, right? That they're paying on that. And I've seen some of that where then it jacks up at $3,000 a month. It used to be $500, now it's $300. that affects the marketability and value. Who wants to buy a condo when the HOA just goes up dramatically? It does affect the value. We got to consider that in lending, right? We're lenders here today. We've been around since 2015. We're going to be here tomorrow, next year, the year after that, and we got to make sure we're available for all our borrowers and customers here that are on this call and that do business with us. So you just got to take them individually. But I'll take another condo question if you have it.
I do have one. If the condo can't be rented for 12 months, can we do a DSCR?
Well, it can't be rented, and then you can be rented short-term rental. Then you go into legality of it, right? It's got to be legally able to do that purpose, right? So anytime you look at properties, I fundamentally look at two questions. Is it legal and is it marketable? So if I can't rent it out business purpose, it's not legal to do that. I don't see how that makes sense, right? You can't do it. Why would you buy a property to rent it out on business purpose? Those are renters, they're investment properties. Why would you buy it as investment property? It kind of contradicts the argument, right? Can you rent it out short term? As that's the purpose of it, and it's legal to do that. We can look at it as a short-term rental.
Great. A couple more. So this is kind of a two-part question. It seems like some lenders have a VOE primary purchase program or stated income primary program. Do we have anything like that?
No, and I go over that. There's a few companies out there that have a CFDI program where they got some licensing through the federal charters to be able to help the underserved market. And so they come out with some type of one month bank statement program, 1 page, and it's kind of more of a stated program. There's lots of rules that come out with that, right? That they have to perform. I think it's more like 70% of all the loans they do have to fit that program. They have more of a liability of any performance issues with that. They actually have to do their own securitization. There's lots of things that go into it. And we didn't go down that road. And then there's some companies that have gone down that road that they probably shouldn't have, right? Because the demographic section, you got to do that, might not do it. So you really got to be careful if you're going into that line segment. And it would impede us from doing other loans because you have to have a certain amount of percentage in that. So we haven't gone down that road for that type of bank charter to do.
Okay, thank you. The kind of second part is going back to us doing exceptions. What would be the max loan amount on a loan if we did an exception?
Wow. Right now it's 3 million. And we're kind of at a hard stop on that of 3 million right now. So we're doing loans up to $3 million. Anything more than that's going to be difficult. And it's really not driven by us. We talk to a lot of investors and a lot of bond traders every week. And those get negatively affected on those large loans. You kind of look at it, right? And I just look at loans today, and it's just kind of as a common sense approach. I've seen ones where, hey, they want 2 million cash out, and the rate's 10%. I go, who wants that? Who would do that loan, right? And so it's really a common sense approach. And you start looking at a $3 million loan. People were still worried about the volatility in our market, right? And those loans that are larger have propensity to have more volatility. And that's where you're trying to limit the risk of those of HPA or delinquency. So you kind of look at that.
And then do you allow a seller held second behind your first?
Yeah, we can go up to a 90 CLTV on a lot of our programs. So yes, I mean, and that's common, right? I don't know if it's that common. We probably see a couple of them a month where you negotiate the deal, they get the 80% with us or 75 and 10% seller carry. Not a problem. We have programs for that.
Awesome. And I can't believe that we're 2 minutes before the end of the hour. I mean, wow. This is a great way to kick off
2024.
The year. I mean, honestly. So everyone who asked the questions in the chat, thank you so much. We're definitely going to follow up with you. So if your question didn't get answered, we will be reaching out to you. So thank you so much for your participation. So And thank you everybody for hanging in there with us. This was a great one. So let's take a look, David, at next month's webinar.
Oh, I thought it would be appropriate. We're talking about the two most common programs in non-QM. Let's get down to really how that is done, right? Let's go into underneath the covers here, look at how is self-employed income actually calculated and the different ways you can do that. So we're going to look at how those are calculated, what appropriate expense factors are done just internally here, right? And I think that'll give you a kind of a way to understand that, so you get more comfort level with that. And then the cash flow of DSCR. I mean, there's differences between long-term rents and short-term rents, and kind of understanding, the vacancy of a short-term rental and what that cap is and where you're looking at that versus a long-term rent, and some of the expenses with that and how those are done in a meaningful way. So you can be an expert. And Rob talked about that during his session. It's like, be an expert, right? You go out there saying expert. You don't have to be an expert at everything, but we get these two programs down, and you can align yourself with one of our highly trained accountants that they know how to structure loans and can do these for you in a more intimate way, one-on-one, or at the broker shop. We have no problem doing kind of whatever topic that you kind of want to learn about. We'll do those for you.
Excellent. Thank you. So stay tuned, everybody, to see when you can register for that webinar for next month. And then lastly, if you are an approved broker with us, thank you so much. We value your partnership. If you're not an approved broker with us, it's very easy to become one. You can go to our website at homexmortgage.com and you can actually apply directly online. Lastly, here it is, Mr. Greider. Call David. He loves it. David, here's David's contact information. If you have any questions, feel free to reach out to him. But I just want to say thank you to Rob Anderson. Thank you, David Greider, for your participation today. Thank you, everybody, for joining us. Happy New Year. We will be sending a copy of this deck and the PowerPoint within the next day or so. So be on the lookout for that. Thanks, everyone. See you next month. Thank you. Bye-bye.